Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Schwan, and in each episode I share my thoughts with you on a topic or a recent development in South African tax. And I try to keep the episodes short enough that you can listen to them if you need a quick coffee break. Our topic for today is, at this point, still a proposed amendment that affects foreign denominated preference shares in foreign companies. So I think before we start talking about the amendment, let's maybe just talk about where you typically find these preference shares. So where I've seen them is in corporate structures where you've got a South African group that invests in another jurisdiction, so sets up an entity there, and one of the ways that entity can be funded is by subscribing for foreign denominated preference shares in that foreign company. I've also seen them in wealth structures where, for example, individuals would fund their wealth structures offshore through these types of preference shares. So what's the issue? If you look at the amendment bills, the taxation laws amendment bill, so I think important, it's not yet legislation. So at the time that I'm recording this, the bill is still the taxation laws amendment bill. But once it's signed into law, it will become the Taxation Laws Amendment Act, and then it will become, at that point, it will be part of the legislation. Now, what we're looking at is an amendment in this bill that will, I would expect it to become the part of the Amendment Act, that seems fairly small at first glance. It's an amendment to the definition of exchange item in Section 24I of the Income Tax Act. Now, just a quick reminder again, what Section 24I does is to say that if you've got an exchange item that's denominated in a foreign currency, so at the moment that definition refers to units of currency, to debt instruments, and FECs and foreign currency option contracts, then Section 24I would basically tax the exchange gains and losses on those items on an unrealized basis. So as they accrue, you'll remeasure the item at the end of the year of assessment. Whether that gain or loss has been realized, the amount, the gain or loss would be included in your taxable income. There are some exceptions to those rules, and I'll touch on one of them a bit later on again. Now, what has been added is a new paragraph E that specifically includes foreign denominated preference shares in foreign companies as an exchange item. So I guess if we unpack this amendment a bit, what exactly is a preference share? So the definition of a preference share in this context refers back to Section 8 capital E capital A of the Income Tax Act, and that refers to a share. It's got two categories. Firstly, a share other than an equity share, and an equity share, there's a specific meaning to it. It's basically a share that is either for dividends or returns of capital, would be entitled to participate beyond a specified amount. So a typical share that would not be an ordinary share would be, for example, a preference share that's entitled to a return of the capital amount that was paid to the company on subscription, and a fixed yield. That wouldn't be an equity share. So those kind of shares are preference shares for purposes of 8EA, and now also for the amendment to Section 24I. And then also the second category of share that is also a preference share is an equity share if the amount of the dividend or foreign dividend in respect of that share is based on or determined with reference to a specified rate of interest or time value. So if you've got a share that is an equity share, but your dividend is determined with reference to an interest rate or time value of money, that share would also be a preference share. So what the effect of this amendment is that if you've got a share that falls into this this definition that's denominated, so in a foreign preference share issued by a foreign company denominated in a foreign currency, that the foreign exchange gains or losses on that share, the balance of that share, would basically be taxed under Section 24I on an unrealized basis. Now, the National Treasury's reasoning as to why this amendment was brought in refers firstly to some of these instruments that, despite being called shares, they are accounted for as liabilities in substance. And the initial wording of the amendment also referred to the accounting treatment, although it didn't look at the issuer side where the liability treatment would be. It looked at the holder side where basically any share that you hold would be a financial asset. And then they specifically talk about a hedged arrangement involving some cross-currency swaps that causes a tax leakage as being the reason why this is introduced. Now, the provision or the amendment comes into effect for years of assessment starting 1 January 2025 and onwards. And just a few observations as to what the effect would then be. I think, as I've already alluded to, Section 24I, the principles would apply to say that your exchange gains or losses on both the capital and the accrued yield that forms part of that's in this instrument would be taxed on an unrealized basis. I think what's very important is that if I look at the amendment at least, I don't quite see that it's limited to this hedged arrangement involving the cross-currency swaps. It seems very wide to me. So any type of, or any preference share in a foreign company denominated in a foreign currency that meets the definition of a preference share would be in there, whether it's hedged or not. Now, for those preference shares to be taxed on an unrealized basis on the exchange gains and losses is I think in my mind, again, a significant deviation from where we were in the past. So in the past, these preference shares were assets denominated in a foreign currency. If we assume that they're held on capital account, this foreign exchange effect would only be taxed on disposal and one would look at paragraph 43 of the 8th schedule as to how it would be taxed. So it's two important things there. It would, in that case, only be taxed on realization, not before that. And secondly, if you're looking at some natural persons and trusts where the instrument was acquired in a currency and disposed of in the same currency, the exchange gain or loss may not have been taxed at all. So I think that's a big change from where we were before the amendment. The other important point, and I think this is probably in a group context quite an important one, is that Section 24I 10 capital A caters for, in a group context where you've got long-term exchange items, for the exchange, the foreign exchange gains or losses on those long-term items to be deferred until the item is realized, so not to be taxed on an unrealized basis every year. Now, 24I10A only talks about paragraph B of the definition of an exchange item. It doesn't refer to the new paragraph E, which then means that this group concession rule wouldn't apply to these preference shares. There is an amendment to 24I10A, but that deals with a different aspect of Section 24I that was amended. So in closing, the first important point to take is that if you've got a structure where you've got foreign denominated preference shares in a foreign company, this amendment is definitely something you would need to consider and look at the effect on your group or on your structure. And I think the second important point, practically it's very significant that it doesn't seem as if the group relief rules would apply to, or the group deferral rules would apply to these instruments. That's it for today. If you like the podcast, Please subscribe on your favorite podcast platform and tell all your friends and colleagues about it. If you've got any feedback or questions, you're more than welcome to send me an email. My email address is in the show notes. And as always, nothing in this episode was intended to be tax advice or a replacement for fact-specific tax advice. Until next time, goodbye.